experienced investor, you're seeing a shift in the return profiles and what operators are projecting, or you should be. Otherwise, you should probably dig into their underwriting a little bit more. And if you're brand new, maybe somebody told you, oh, you can get, 8 to 10% cash on cash returns and double your money every 3 years. And then you're seeing deals that come across your desk now and they're not quite matching up with your expectations or hopes. So I think as an LP, it's very important to really understand the market cycle that you're in, that we're in, and as an investor in general, and understand the forces that are driving that.
That was Andrew Davis. Stay tuned to learn what best-in-class investor relations looks like. The limited partner shares in the potentially outsized returns of a well-planned and executed investment, but as a passive investor, and has the maximum leverage on their most precious asset, their time. And that is why we're here together. 90% of the millionaires out there built their net worth with real estate. However, 0% of the billionaires are hands-on managing their real estate assets because there simply isn't enough time. My name is Jake Wiley, and for the past 16 years, I've been investing in real estate, and I've learned a thing or two. But the most important lesson is how to leverage the expertise and time of others to maximize your investment potential. Welcome to the Limited Partner Podcast.
All right, partners, welcome again. This is your host, Jake Wiley. This week, I'm joined by Andrew Davis. So he is the Director of Investor Relations at PassiveInvesting.com. Andrew, welcome to the show.
Hey, Jake, thank you so much for having me.
Well, Andrew, I know that, it's July of 2022, and we're starting to go through an economic cycle. So I'll be really interested to get your take on some of these things. But before we dive into the real nitty gritty of the show, I'd love to give our audience a little bit of background on who you are and PassiveInvesting.com and the connection there. So I'll hand it over to you.
Yeah, absolutely. Well, thank you again so much for having me. As you mentioned, my name is Andrew Davis, and I currently serve as the Director of Investor Relations for PassiveInvesting.com. PassiveInvesting.com is a commercial real estate private equity group, and we focus on providing risk-adjusted investment opportunities to our limited partners, our passive investor partners in strong markets and higher quality asset classes. And to date have raised over $400 million from limited partners to acquire well over $1 billion in real estate. We have over $1 billion in assets under management right now in partnership with roughly 2,000 limited partners. About 70% of those are repeat investors. So invest with us over and over again. And my background was very fortunate to grow up with two great parents and two entrepreneurial parents. And so I saw the merits of controlling your own time, owning your own business early on. Not great or savvy investors by their own admission, but I'm definitely kind of independent minded. And I think that really served me well. Growing up made me curious and want to learn and start businesses. And then by chance reading Rich Dad, Poor Dad, which is probably at least 60% of everybody's story, if not more, just opened my eyes. Just a very simple, little fable or parable. That's how that story reads to me, but really cemented the principles of assets versus liabilities and the importance of owning assets. And that was the catalyst for my real estate investing journey. And I wish I could say it was all smooth sailing. I learned a lot, flipped some houses, did some buy and hold rentals. Some did well, some not so well. But really what I learned throughout that process, I learned a lot about myself. I learned about the power of real estate, even a quote unquote bad real estate deal, a lot of flexibility there. And I also learned just really specifically what I'm good at and what I'm not good at. And what I learned that I was good at is really the relationship aspect of it, the capital raising side of it. So before I ever came to work for PassiveInvesting.com, I had raised capital for my own deals, flips, buy and hold rentals, a 12-unit apartment deal that we put together. And so I felt confident in having those conversations and confident in the value to a limited partner, a really busy investor, whether it's a doctor or a lawyer, a high earning professional, or somebody that just doesn't have the interest, time, or desire to actively invest in real estate. And so it was a really good match for what PassiveInvesting.com and the leadership there was looking for when I got started. So I've been with them for about 18 months now. And in mid-July 2022 here, or late July 2022, I should say. It's been a really interesting, but a really great year for us as well. And so I'm just happy to be here and have a conversation with you.
Well, I think that's a great story. And again, yes, we hear about Rich Dad, Poor Dad more often than not on the show at this point. I think that's a really cool aspect is that is a book, to your point, it's like a parable, a fable that gets people thinking in a way that's, gets them off the couch and actually doing something versus just being like, okay, that's another book that I read. But let's just really jump into it. The market is changing. I mean, we've been on this incredible upswing, like COVID happened and there's
Yeah.
this moment in time where everybody took a deep breath and are like, what is going to happen? And then we can't kind of move through kind of the COVID piece of it. And like things just went gangbusters. And now the Fed's raising rates, interest rates are crazy. So there's a two-part question, but let's start with the first one. What is it that limited partners should be thinking about, looking for, and kind of expecting right now at this point in time?
Yeah, absolutely. So I think it's really important for a limited partner, just an investor in general, and it depends on their context, right? And so we've had some great conversations with investors and internally, right, about how the landscape's changing. And so you've got people that are new limited partners, and maybe they've done one or two LP deals, and you've got folks that have been doing this for a long period of time. And so if you've been doing this for a long period of time, the offering memorandums or pitch decks or whoever's email list you're on, right? Highly likely that you're going to be seeing lower returns than what you saw a year ago or 2 years ago or 3 years ago, right? So if you're an experienced investor, you're seeing a shift in the return profiles and what operators are projecting, or you should be. Otherwise, you should probably dig into their underwriting a little bit more. And if you're brand new, maybe somebody told you, oh, you can get, 8 to 10% cash on cash returns and double your money every 3 years. And then you're seeing deals that come across your desk now and they're not quite matching up with your expectations or hopes. So I think as an LP, it's very important to really understand the market cycle that you're in, that we're in, and as an investor in general, and understand the forces that are driving that. And so there's a concept in kind of traditional, equities or stock market investing called dollar cost averaging. And I think that applies to private equity real estate investing as well. I actually just wrote an article about this for our monthly newsletter here, but just the idea that, hey, if you are choosing right now to sit on the sidelines because the deals that you're seeing aren't as profitable or as high yielding as what you're used to in the past, my opinion and our group's perspective and driving philosophies, that's a mistake, because what's happening right now in the marketplace and what's driving those compressed returns, we feel is not, a frothy market or overvalued real estate, but it's actually a fundamental shift in the marketplace. And you've got a couple of things that are driving that. One, of course, you have interest rates. That's what everybody's talking about right now. So rates have gone up several hundred basis points or several percentage points here over the last several months. And at the same time, leverage has gone down, or what lenders are willing to give in terms of loan to value or loan to cost has gone down. So you have a higher cost of capital. So you've just got more expenses coming out of those assets that you are acquiring as an operator from a financing perspective. And then on top of that, just from a value perspective, so I think kind of one of the opinions is that, okay, once we hit a certain interest rate level, we're going to see a precipitous drop in prices and it's going to create all this opportunity. And that's going to be the time to jump. And we think that's unlikely. And the reason for that is there's been a fundamental shift in the supply and demand equation. And so what happened post 2008 recession real estate crash is a lot of developers went out of business, more on the single family side, but certainly commercial developers as well. And they never came back into business, the biggest developers in the country. And so what that did was create an undersupply in the housing market, which is why you see these year over year, month over month single family housing pricing gains. And even with rates going up so dramatically, typically the first market to be affected there is single family real estate. It's affecting consumers. And for every point interest rates go up, a bunch of people, millions and millions of people get priced out of the marketplace. But what's happening? And so you've got all these people now that can't afford homes and are opting to rent instead. So you have a huge chunk of people that traditionally in this time of their life would be in what we would call the household formation stage. They're getting married, they're having kids, they're moving out of urban centers into the suburbs. They want more land, better schools, neighborhoods, etc. Well, a lot of those folks just simply either can't afford to buy a home or feel that the market's too pricey, feel that it's unwise to buy a home, but they still want to be in a neighborhood. They don't want to be in an apartment if they've got a couple kids and a dog and work from home. And so that's why you see this build to rent sort of craze or trend coming about. It's to satisfy that market. And then you still have the same amount of people, if not more, that are opting to live in apartments as well. And so you've got this fundamental shift both in the debt markets, in the demand for rental housing. And then on top of that, you have a significant increase in investment demand. So you have a ton of institutions that have reallocated big chunks of their portfolio as a result of COVID from office, retail, hospitality, which proved to be more volatile, and moved billions and tens of billions of dollars into the real estate market. And Blackstone is a great example of this. So they just announced, or just kind of in their most recent quarterly, that they increased their real estate portfolio holdings by 54% over the last period. And the majority of that, I believe all that is residential and industrial. And so that points that says, hey, this is the biggest private equity group in the world. They're continuing to double down and bet heavy on real estate. And so that's how we're approaching it as well. So we're looking at, yeah, cash flows may be constrained or compressed right now, but our perspective is that's probably the case for the long run until the supply issue corrects. And there's no sign of that happening anytime in the near future. And so that's a very long-winded answer, but I think it's important because we're not sitting out and saying, I guess we'll just wait for things to correct. We're continuing to invest, and we're confident in the long-term prospect, especially in the markets that we're investing in and the types of assets that we're buying.
So I want to dig in a little bit on, you really talked about cash flow and cash returns. And, are the deal economics significantly different? Let's just say, I'm just going to make up numbers and you can maybe correct me a little bit. So let's just say in the past, kind of an 8% pref and maybe like a 70-30 split, right, between the GP and the LP. And that's just kind of a standard structure. Has that changed? Or are you saying that the 8% pref has gone down? Or because what I want to kind of articulate here is that you may be projecting different numbers, but the economics of the deal may actually be very similar over the long run, right? And those are, that's an interesting way to look at it.
Yeah, I completely agree. And I think that's a really important distinction. So there's kind of two questions there. One, right, what's the deal structure, right? When is the GP getting compensated, right? How is the LP being compensated? And so I'll touch that first. My opinion and our opinion is that those fundamentals should not change. And because we want to be investor first, right? And so our typical equity split it's a 7% preferred return. So we're not taking a dime until our investors get at least 7% annualized return on their capital. And then after that, it's a 70-30 split to a 13 IR and then 50-50 thereafter. And that's not changed for us. And we don't actually think that the profile of the deals has changed. We always land very conservatively. So could we exceed 5 to 6% cash on cash return? Absolutely. Could that deal hit much higher than a 14% internal rate of return? Absolutely. But what we're doing is just looking at, okay, what does history show in terms of not the last several years where you've had double-digit year-over-year rent increases, but what does history show in terms of more stabilized year-over-year rent increases? So depending on the deal and the market, we're underwriting anywhere for, on average, 3 to 4% year-over-year rent increases post-stabilization, which is very conservative. Now, we're buying in markets where they're projecting double-digit rent increases for the entire hold period. So if we achieve that, absolutely, those returns are actually going to be very similar to what we've been delivering. And I think that real estate is going to continue, especially in strong primary markets. The value is going to be there. I think the cash flow projections are probably pretty accurate, at least from our group. I can't speak to all groups and all operators, but for us, I think what really investors, where they need to adjust their expectations down is on the month-to-month cash flow. And I think where they can remain relatively confident or with a high degree of confidence is in the overall returns with the appreciation of the assets, both from a market perspective with all the demand from institutions and individuals, but then also just from what's happening in the marketplace as well.
Yeah. And I think that's a really important point, is that you're saying that the structure of your deals hasn't actually changed. So let's just assume that all things kind of works itself out, interest rates work themselves out. You could see the same returns as you did in the past. Just because your projections are lower doesn't mean that those your overall returns have to be lower. Right. It's just
that's exactly right.
Yeah. Okay. So I guess in terms of deal flow, right, that's another thing we're seeing, because, you made a great point of, do you just sit on the sidelines right now and wait for the market to correct? Or do you look at, kind of getting in and just saying I'm an investor? Because if your dollars aren't working, your return is zero and then inflation's eating it. Right. So if your dollars are working, that there's an opportunity to grow. And again, like we just talked about, you may still end up with the same returns as what you were seeing last year. But, I think conservatively, everybody's projecting a little bit of a tightening, which is, if you're right, if they aren't, they should be. I guess in terms of deal flow too, that's another issue, is that we've actually seen deal flow slow down a little bit. So if you're waiting and sitting on your hands, it's actually going to be harder to find deals. But I'm also, love to hear your perspective on that.
Yeah, I agree. What's really interesting is we've had a lot of 1031 investors come to us recently saying, hey, I've got a sale. We have 3 closing this Friday for a total exchange amount between 3 different people, but I'm just talking about the amount of capital, about $10 million that needs to be placed within 45 days. And so what's interesting is you have a lot of people that have liquidated, that saw the writing on the wall, or just said, okay, I've doubled or tripled my money here, and I'm going to go ahead and lock that in. So there's a lot of capital looking to be placed. And if you look at people are always trying to figure out right now, are we in a recession? And so you have people looking at the yield curve, and you have people looking at interest rates, but you also have people looking at consumer spending and consumer savings and consumer debt. And the consumer is actually in a pretty darn good position right now relative to our last downturn. Yeah, so deal flow is interesting. There's still a lot of capital looking to be placed. I think some sellers are pulling back and waiting to see how things shake out. But I think for us as a group, we're very consistent. We have a very strong acquisitions team with physical presences in our key markets and really good broker relationships. So our deal flow has remained relatively strong. Now our deal profile has changed in terms of what we're going after, not in terms of quality, but just in terms of size, because we were buying, the biggest deal we bought to date is a $110 million deal. But now a deal like that becomes more challenging because the equity piece is much bigger and the returns are more compressed. So our deal profile has changed a little bit just really in terms of size. But for us, your point, especially in an environment right now with the amount of inflation that we've had. And again, inflation is not only driven by low rates, right? It's also driven by supply and demand as well. And so one of the key drivers for that, similar to the real estate side, is because of all the supply chain issues that we've had. And we've all heard about this, right? There's a car shortage and there's a chip shortage and there's a baby formula shortage, right? And so you've got inflation being driven by multiple factors. And so as an investor, if say 8%, whatever inflation was this last year, if you elect to sit on that capital, not only are you not earning money, but you're losing significant amounts of the purchasing power of that capital. So real estate, especially multifamily scaled real estate in strong markets, is, if nothing else, an incredible hedge against inflation, but there's still a lot of upside there as well. So that's our perspective. And for us, I think deal flow remains very strong, and we're confident in the long-term outlook because we're only investing in markets that have very strong fundamentals, employment and job growth. And so those are going to drive those values, I think, even more so than any downward pressure that would be created from increasing interest rates, cost of capital, et cetera.
And, maybe this isn't really your area, but I think with the debt market really creating a lot of, stickiness or kind of holding things up is that banks just don't even know what to do. So you're right, a lot of capital. It's actually not the equity that's people are looking to place equity, they grow their equity, but it's the debt, right? So then, a couple of things we're definitely seeing is rates are going up. And then the banks are requiring higher amounts of equity going into the deals, right? So if you're used to financing something at like a 4% interest rate and up to 75%, now that's coming down to 65% of the total deal, and the rate has gone up, right? That obviously impacts our profile, but I think beyond that, there's also just the factor of can you find good debt right now to do the deals?
That's right.
What are you guys seeing there?
Yeah, so for us, we really took advantage of this previous debt market, and I think did it very well. And so we were getting 75% loan to value, loan to cost, and then rates in the mid to low threes. Now that was floating debt, that was floating rate debt or bridge debt. So what we did is we bought an interest rate cap. And so basically we just made sure that rate could not increase more than 150 or 200 basis points. And so what happened, the biggest shift for us is you can still get floating rate debt, but they're going to charge you so much for that interest rate cap that it's going to throw off the fundamentals of the deal. That cost of capital is going to become too high. And so for us, we're seeing the same thing. We're seeing rates go up. We're seeing lower leverage. And for us, and that's part of what's changing the return profiles as well. But for us, our capital markets team and our acquisitions team is definitely spending more time with our debt partners, with our capital partners there. But for us, we actually like that because our goal as a group is we want to be doing this for the long term, right? We want to be doing this for 20, 30, 40 years. And so if the debt markets are, causing these deals to become inherently more conservative, which as we know, fixed rate debt, lower leverage, that's more conservative, then we're okay with that, right? And so for us, we're saying, hey, of course, we all want to 2x our money in 3 to 5 years, and we want to see 10% cash on cash and all these returns that folks have gotten used to. But really, the name of the game, as we all know, is don't lose money. And so for us, these debt markets are allowing us to be positioned even more conservatively to give both us and our investors that margin of safety and that degree of confidence in the security of their principal.
Yeah, and I think probably another thing to highlight this, you can probably respond to this as well, but the lenders themselves, the bankers, don't want to not write loans, right? Like they want to get these things across. They're incentivized to they're actually out there looking and saying, like, who are our partners that are weathering this storm with us? And those
That's right.
relationships like will really carry water when, things change, or, who's going to get the
Hmm.
first look. And that's really important, So if you guys are looking at it and saying, hey, we're not just going to park it on the sidelines and wait for it to make an adjustment, like, you're going to have favored nation status coming back once things normalize, because we'll have a very good memory of who stuck with them and who played the game when the rules are out the window.
That's exactly right. Yeah, that's a very good point. This really is for LPs that are thinking about, hey, who they want to invest with. There really is something to staying power and to groups that have those kinds of relationships, both with brokers on the deal flow side, but then also with debt and, capital, whether it's Fannie Mae, Freddie Mac, or private, whatever it may be. And so for us too, we see a lot of value, and just for those reasons as well, continuing to just have that staying power and continuing to invest and acquire even in a quote unquote, volatile or uncertain market. But yeah, so that's a great point.
Well, let's change gears a little bit. You guys diversify into, we've kind of really talked about multifamily, even if indirectly in this
Yeah.
conversation. But you guys are looking at other asset classes. I think it's been part of the growth strategy, car washes and other asset classes. Let's talk a little bit about that, why you guys are looking at it and kind of what you see the benefits.
Yeah, absolutely. So, our vision for this company, and the reason it's named passiveinvesting.com and not, apartment investors or whatever, it's something that would pigeonhole us into a specific asset class, is we didn't want to be. We wanted to have the option to diversify. And then we also saw the writing on the wall with returns compressing, with a lot more competition for deals. And something that's really neat about our group and the principals and some of our key employees is we have some really strong operational experience with our leadership, having started and scaled multiple successful businesses. We have, great asset management experience. We have great, acquisitions in terms of people that have been in commercial real estate for a long time. And so we have, I think, a very unique leadership team and just overall team in general, which allows us to go into a space like car washes. Our hypothesis is that car washes, mobile home parks, and self-storage were about 10 to 15 years ago. Fundamentally, they have a lot of the same fundamentals in terms of being a very high margin, of having very fragmented ownership. So I believe less than 15% of the car washes in the country, and this may have changed a little bit since the last count, but less than 15% of the car washes in the country are owned by operators that own 5 or more assets. So 85% roughly are owned by mom and pop owners that maybe own 1, 2, 3 sites. And so you've got that fragmented ownership. And what we've seen is basically going into the space, the reason why it hasn't consolidated more so is that there's not a third party management model in place for it, like you have with storage, multifamily, hotels, et cetera, where you can close and day one say, okay, you go manage this, we'll pay you 2.5, 3, 4%, depending on who the manager is. And let us effectively let us know if anything goes wrong. I mean, that's pretty much how it goes, but car washes are not, there's no such thing. And so building out this management model, this operational model, the best practices and SOPs, and being able to buy 2, 7, 4 sites and day one implement our value add plan with marketing, with operations, with employee training, with just on-site customer experience improvements. We see a lot of value and kind of unique value proposition for our group there. But for us, we know that different assets go through different life cycles, and being able to identify those, see the opportunities and capitalize on those, and then have those opportunities available to our investors, we feel that we would be remiss if we were to only stay in one asset class. We've mastered that. We have a great acquisitions team. We have a great asset management team. We have a great property management team, that effectively runs pretty smoothly. And so then that allows us to go and branch out into other asset classes. And then in this market cycle allows us to provide much higher returns to our investors. So car washes, depending on the deal and the assets in the deal, triple in some cases, or double to triple what we're looking at for returns for multifamily.
Yeah, I think that's really helpful. And I will tell you, the secret's out on car washes.
Nope. We know, and we know there's a short runway, and we're executing accordingly.
Well, that's awesome. Well, we're going to change gears in a pretty drastic direction again, because, a lot of the folks that I talk with, they're like, all right, well, this is all well and good. I'd like to get involved, but like all my money's tied up in like a 401k or an IRA, self-directed IRAs or other ways to invest out of retirement accounts. I guess, talk to me about your philosophy and how that works.
Yeah, absolutely. So my wife and I invest with a self-directed IRA. Roughly 20% of our investors do. My mom does. So yeah, I mean, I think it's a great avenue to do that, depending on how much this can be a very great time to do that because of the run up in public markets. And so folks, if they've just been sitting on a 401k or an IRA for some time in the public markets, it's likely they've got some pretty big gains. And it's a really simple process to take a chunk of that and roll it over into a self-directed account. And then from there, you can invest in pretty much anything. So I'm a big fan of that and diversifying those retirement savings. And then, another, I think, thing that people don't really think about, but even with higher interest rates, I have a couple of buddies that are doing this right now, and we do this as well, but we utilize our HELOC for investment opportunities. And I know what I'm paying on my HELOC, and I know what I can get from investing that capital as well. So we do a little arbitrage there as well, but there's a lot of creative ways to do it other than just investing, your own pure cash.
Yeah, I think, one, the self-directed IRA, if you haven't heard of it, just look it up, right? It gives you the opportunity to basically say, this is where I want to put my money. And, there are
That's
rules
right.
that you have to follow, but it's not like you're trying to go to your financial planner and get him to send your money to a syndication because it blow their mind. Like that's outside of their scope. But a self-directed, you have
Well,
the
and
ability to do that.
yeah. And most of them won't do it because they're not incentivized to do it. They'll tell you it's risky because it's not within their kind of wheelhouse or products that they're selling. And then if you've got, a Fidelity or Vanguard or something, they're not going to do it, or they're going to make it so horribly difficult for you to do it that you'll give up anyway. So it's really best to we work with a couple of great self-directed IRA providers, and they generally make it very to invest your capital as you see fit.
Yeah, I think that's the point, right? Is that like you really need to find a self-directed IRA provider. Like their fee structure is built in a way because they know you're going to invest your money in that direction. And then the other point you brought up, which I think was an interesting one, right? Has some risk associated with it, is like arbitrage, right? Is taking a loan.
Yeah.
Let's just say you can get a loan at 4%. And then, your return is coming in, even if it's like 6%, there's a 2% difference, right? And it's arbitrage. So it's like theoretically, you're just making that difference with somebody else's money. So when you hear arbitrage, like if you're out there thinking like, what the heck is he talking about? Like that's the play. And obviously there's risk there because if it goes,
that's right.
If it goes the other way, right? Like you're having to come up with cash, but doing your diligence and kind of finding deals that you feel really good about.
That's right.
So great points. Well, Andrew, this has been a great conversation. I know we really got into the kind of the nitty gritty on the market and, your philosophy and how, people should really stay in the market and keep investing. But I like to wrap up every show with a bit of gratitude, giving you kind of the platform to say thank you publicly to somebody that's helped you out along the way, or maybe giving you a leg up that you probably didn't even deserve. So the floor is yours.
Gratitude for somebody that helped me along the way. Man, there are so many people that come to mind that have just been very good to me over the years. Well, this is indirect, but I'm a big fan of, I guess I would say, like secret mentorship. And what I mean by that is I read a lot, and there's people that I follow and listen to that have no idea who I am, but they've been very impactful on my life. And, I knew a little bit about him, but didn't know a ton, or didn't just kind of know the extent of his character and the kind of human being he is. But he was at a multifamily conference, and the topic was intended to be investing and making money and et cetera. And really, he over and over again throughout the hour that he was being interviewed, and then even afterwards, and kind of some smaller, more intimate conversations, he just over and over again just brought the attention and the focus back to people in need and how much joy he gets out of giving and caring for other people. And I think that for all of us in this world, it can be very easy to get kind of tunnel vision, right? I want to hit this level of passive income, or I need to allocate $100,000 or $200,000, $50,000, 20, whatever it may be. Right. And it's very easy to think of those as problems. And somebody asked him during this thing, they said, well, what's your biggest problem? And he thought about it for about 2 seconds. He said, I don't have any problems. He said that the guy that is sleeping on the street, he's got problems. The family that can't afford to buy groceries, they've got problems. And it was just a really refreshing perspective. And I think it's applicable, right? Because what we're talking about, right, in terms of interest rates and markets and returns and all that, there's fear. And the fear is, am I going to lose money? But likely, if you're listening to this show, that fear doesn't mean, will I have a place to live, or will I be able to take care of my kids, or will I be able to eat? And that fear, the fear of those things, is very real for many people in our country and many people in our world. And so I think for me, him, and different pastors and people that I listen to and read and follow, just that continual reminder that there's a ton of people in need, not only of financial means and support, but also just attention and encouragement and a little help. And we can, of course, be good stewards of your finances and look for great investment opportunities and all that. But the more that we can, I think, look externally, especially in a challenging time in our world and our economy, the happier we'll be and the better off a lot of other people will be as well. That's my soapbox, but that's just really stuck with me over the last month.
Got it. And I just want to confirm that was Shaq, right?
Yeah, Shaquille O'Neal.
Yeah, that's the man.
Yeah.
Very cool story. You're right. I think that when you keep your focus on the right things, good things come of it. And it's easy to get really focused on, yourself, immediate future, like where you're trying to go. So I really appreciate that.
Yeah.
Andrew, thank you for being on the show. This has been an incredible conversation.
Jake, thank you so much for having me. I really enjoyed it.
I hope you've enjoyed today's episode, and I'd actually love for you to contribute to a future episode. If you have a question you'd like answered or a topic or a guest to bring on the show, please email me at jake@thelimitedpartner.com. Now I realize there's a lot of lingo that's thrown around on these shows, so I've created a cheat sheet for you with the top 26 terms that come up most often. Head on over to thelimitedpartner.com/lingo for the list. Enjoy, and we'll see you next time.